in the shadowed corridors of global finance where fortunes rise and vanish like morning mist, a stark warning echoes that every serious gold and silver investor must confront today. We find ourselves perched at valuation heights in major equity that precisely echo the towering summits of 1929 and 2000, exact thresholds that once preceded the most punishing downturns in modern American financial history. Those earlier peaks did not merely correct, they unleashed destruction on a historic scale, erasing 89% of market value in the aftermath of 1929 and triggering the Great Depression that reshaped economies worldwide, while the 2000 technology implosion devastated 78% of the NASDAQ, vaporizing retirement savings for countless families who had embraced the seductive narrative that equities climb forever upward. This moment carries profound implications for precious metals enthusiasts. I am not forecasting an instantaneous collapse tomorrow, nor offering any calendar date for dramatic events. Instead, the sophisticated proprietary measures I have refined and relied upon throughout a 50-year career tracking market cycles are now displaying readings that align almost identically with those fateful historical crests. These tools go far beyond simple price observation. They integrate sentiment extremes, credit expansion patterns, speculative fervor, and the widening gap between asset prices and fundamental economic output, signals that have proven reliable time and again in identifying when euphoria detaches from reality. Yet the situation grows even more precarious when we layer in geopolitical realities that receive far less public emphasis than they deserve. Consider this. Authorities in Beijing possess the capacity to jolt global markets into turmoil overnight, and they could achieve this without deploying military forces, initiating direct conflict, or resorting to any of the high drama scenarios that portfolio managers typically stress test. A carefully worded declaration concerning Taiwan could suffice. Let me unpack exactly what this means and why it matters deeply for anyone holding or seeking exposure to gold, silver, and other tangible assets. This convergence, extreme valuations meeting concentrated external triggers, stands as perhaps the most hazardous market architecture observed across my extensive professional journey. That is why I urge you to absorb every segment of this presentation. Around the halfway mark, we will delve thoroughly into the mechanics of a potential semiconductor supply disruption scenario, exploring how it might accelerate into one of the most rapid market adjustments ever recorded, and crucially, which protective positions in the precious metals realm make the most sense to establish proactively rather than desperately after the fact. Skipping ahead would mean missing vital context, because the bubble backdrop illuminates the true scale of the blockade risk. Both facets interconnect inseparably. What I share here builds upon recent television commentary while drawing from 5 decades of close study into how overextended markets behave when confronted with sudden external pressures. To appreciate the current setup fully, we must first ground ourselves in the bubble dynamics at play. When most market participants hear the word bubble, their minds jump immediately to elevated share prices alone. That view, however, barely scratches the surface. True bubble conditions encompass a complex interplay of psychological, structural, and monetary factors that create fragility beneath the glittering surface of rising indices. Throughout history, such environments have shared common traits. Widespread belief in a new era where traditional valuation metrics no longer apply, surging retail participation fueled by easy credit, corporate leverage reaching unsustainable heights, and a narrowing leadership group where a handful of sectors or companies drive the majority of gains. In the late 1920s, industrial optimism and margin debt propelled stocks to dizzying levels before the reckoning. The dot-com era repeated the pattern with internet enthusiasm, where sky-high price-to-earnings multiples on unprofitable ventures became normalized until reality reasserted itself brutally. Today, similar patterns emerge in concentrated technology and artificial intelligence enthusiasm, where narratives of transformative growth justify valuations detached from current cash flows or even realistic future projections. My indicators, honed through cycles, including the 1970s inflation shocks, the 1987 crash, the savings and loan crisis, the Asian financial meltdown, the early 2000s technology unwind, the 2008 global financial crisis, and subsequent quantitative easing distortions now register readings that parallel those earlier danger zones with remarkable fidelity. These are not casual observations, but data-driven assessments that have guided successful navigation of multiple booms and busts. For gold and silver market observers, this backdrop carries special significance. Precious metals have long served as barometers of monetary distrust and economic anxiety. When equity bubbles inflate on waves of liquidity and optimism, underlying currencies often face subtle debasement pressures that quietly bolster the case for hard assets. As those bubbles approach their mature stages, any catalyst capable of puncturing confidence can send capital flowing rapidly towards stores of value that exist outside fragile financial systems. Silver, with its dual role as both monetary metal and critical industrial input, offers additional layers of opportunity and complexity in such transitions. Now, let us examine the second pillar of vulnerability: the potential for swift disruption originating from cross-strait relations. Taiwan stands at the heart of the global semiconductor ecosystem. The island produces the overwhelming majority of the world's most advanced chips, components essential not only for consumer electronics but for automobiles, medical devices, defense systems, data centers, and the entire digital infrastructure powering modern economies. Any meaningful interruption in that supply chain would ripple outward with breathtaking speed and force. Imagine a scenario where tensions escalate to the point of export restrictions, naval maneuvers creating uncertainty around shipping lanes, or even a targeted blockade affecting key production facilities. No full-scale invasion would be required. Markets hate uncertainty, and in today's highly leveraged, algorithm-driven trading landscape, the initial reaction could prove self-reinforcing. Selling begets more selling as stop-loss orders trigger, margin calls cascade, and risk models force widespread deleveraging. What begins as a regional geopolitical headline could transform within hours into a global liquidity event, pressuring even the strongest balance sheets and exposing weaknesses hidden during the long bull market. Historical precedents offer instructive parallels, though none match the current concentration of semiconductor capacity. The 1973 oil embargo demonstrated how a single commodity choke point could destabilize entire economic blocks. More recently, the COVID-era supply chain snarls illustrated the fragility of just-in-time manufacturing models reliant on distant specialized production. A Taiwan-related disruption would amplify these effects exponentially given the irreplaceable nature of cutting-edge chip fabrication. Recovery timelines could stretch into years, involving massive capital expenditures to onshore or friendshore production, efforts already underway but far from complete. In such an environment, gold typically emerges as a primary beneficiary. As investors flee perceived risk assets, central banks accelerate diversification away from traditional reserves, and currency hedging demand intensifies. Physical bullion attracts steady inflows. Silver often follows with greater volatility, but potentially higher upside, given its industrial supply constraints and monetary characteristics. Mining equities, particularly those with strong balance sheets and jurisdictional advantages, can provide leveraged exposure, though they carry their own operational risks that demand careful selection. The speed of a potential decline bears special emphasis. Modern markets operate with unprecedented connectivity and leverage. High-frequency trading, derivatives amplification, and concentrated options positioning mean that negative shocks propagate faster than in previous eras. A 1929-style multi-year grind lower might instead manifest as a compressed, violent adjustment lasting weeks or months before stabilization attempts emerge. This compression favors those already positioned in defensive assets rather than those attempting to rotate amid panic. Preparation, therefore, becomes paramount. Serious precious metals investors should consider several interconnected principles. First, maintain appropriate physical holdings outside the banking system, allocated, audited, and stored securely to ensure true ownership during periods of institutional stress. Second, evaluate mining companies not merely on production profiles, but on their exposure to geopolitical risks, energy costs, and environmental pressures that could intensify during broader uncertainty. Third, monitor currency developments closely, as dollar strength or weakness can influence metals pricing in counterintuitive ways during flight to safety episodes. Diversification within the sector also merits attention. Beyond bullion, explore related commodities with overlapping supply dynamics, such as copper for its role in electrification trends that may accelerate amid supply chain reshoring. However, always balance enthusiasm with disciplined risk management, including position sizing that survives drawdowns and the emotional discipline to avoid chasing momentum at cycle extremes. Looking back across the decades, the recurring lesson remains clear. Markets move in cycles of expansion and contraction, euphoria and capitulation. The 1929 episode taught humility about leverage and the dangers of universal optimism. The 2000 technology correction reinforced the perils of narrative-driven investing detached from earnings. Each episode ultimately redirected capital toward real assets, including gold, which began its epic bull market in the 1970s amid similar monetary experimentation and geopolitical strains. The early 2000s saw renewed interest in silver as industrial demand recovered alongside monetary hedging. Today's configuration carries echoes of those periods, but also unique features shaped by unprecedented central bank balance sheets, technological concentration, and shifting great power dynamics. Demographic trends, including aging populations in developed nations and rising middle classes in emerging markets, add further layers to demand projections for both monetary and industrial metals. Environmental imperatives around energy transition further complicate supply forecasts for silver and related materials, potentially creating structural tightness even absent geopolitical shocks. As we navigate these waters, maintaining perspective proves essential. Not every risk materializes, and markets have demonstrated remarkable resilience on numerous occasions. Yet prudent stewardship demands acknowledging probabilities. Rather than clinging to hope alone, the indicators suggest elevated caution is warranted. Those who studied past cycles understand that the transition from late-stage bubble to adjustment phase often catches even sophisticated participants unprepared if they remain fully invested in the prevailing narrative. For the gold and silver community, this represents not merely a defensive posture, but a strategic opportunity to accumulate quality assets at favorable relative valuations before potential volatility intensifies. Education remains the foundation, understanding not just price charts, but the fundamental drivers of supply, demand, and monetary policy that ultimately determine long-term trajectories. Community dialogue, independent research, and consultation with trusted advisors all contribute to informed decision-making. Let us now explore the blockade scenario in greater depth as promised. A statement from Chinese leadership clarifying or escalating positions on Taiwan could immediately heighten perceived risks around semiconductor flows. Major foundries concentrated in specific geographic clusters become focal points of concern. Logistics providers would face immediate insurance and routing challenges, driving up costs even before physical disruptions occur. Downstream manufacturers across continents would begin inventory builds, straining other supply lines and creating secondary bottlenecks. Equity markets, particularly those with heavy technology weighting, would likely gap lower as earnings forecasts require rapid revision. Volatility indices would spike, prompting hedging activity that further pressures prices. Credit spreads would widen, reflecting increased default concerns in leveraged sectors. In this flight to quality, government bonds might initially attract flows, but questions around long-term debt sustainability in major economies could quickly redirect attention toward non-sovereign hard assets, precisely where gold and silver reside. Historical analogs, such as the 2011 debt ceiling debates or the 2020 pandemic onset, show how rapidly sentiment can shift and how precious metals respond. Gold posted strong gains during those episodes as uncertainty premiums expanded. Silver, though more cyclical, eventually followed suit as industrial recovery narratives took hold. A semiconductor shock would likely combine elements of both financial and supply-driven crises, potentially generating outsized moves. Quantitative perspectives help frame the stakes. Global semiconductor sales exceed $500 billion annually, with advanced nodes representing an increasingly vital portion. The economic multiplier from chip-enabled technologies, ranging from artificial intelligence applications to automotive electronics, defies simple calculation, but clearly underpins trillions in broader activity. Any sustained 20 to 30% reduction in supply could shave meaningful points from global growth forecasts, prompting policy responses that further influence metals markets through interest rate and currency channels. Investors should also contemplate second-order effects. Accelerated efforts to diversify chip manufacturing would boost demand for construction materials, specialized chemicals, and energy resources, all intersecting with mining sector dynamics. Silver's role in photovoltaics and electronics positions it favorably within green technology supply chains, even as short-term industrial slowdowns create countervailing pressures. The net outcome often favors patient holders who avoid forced selling during maximum fear. Throughout my career, one principle has remained constant. The assets that perform best during resolution phases are those acquired before the consensus recognizes the shift. Positioning after panic has already set in usually means accepting less favorable entry points and higher emotional costs. Gold and silver portfolios built methodically during periods of relative complacency have repeatedly rewarded their stewards when broader markets faltered. As this discussion draws toward its conclusion, remember that market cycles test character as much as capital. Discipline, diversification, and a long-term horizon separate successful participants from those who merely react. The current configuration warrants vigilance, not alarmism. By understanding both the valuation extremes and the specific catalysts that could accelerate change, investors in the precious metals space place themselves in a stronger position to navigate whatever unfolds. Continued monitoring of key indicators, ranging from commitment of traders' reports in futures markets to geopolitical developments and central bank purchasing trends, provides ongoing guidance. Educational resources, reputable industry publications, and direct ownership of physical metal all contribute to resilience. The journey through financial history reveals that those